Welcome, traders, to another Tickmill trading update with me, Patrick Munnelly. Want to update the SP 500 using the Emini futures contract and put together some potential action areas for the trading week ahead and look at some realistic price targets that we can look to achieve this week. So before we jump into the technical picture, as always, want to take a look at the market dynamics and where we are from a market overview perspective. Using the Goldman Sachs trading desk update over the weekend, we can see that the S&P 500 rose by just over 1% last week. Investors continue to grapple with the implications of the federal government shutdown, new drug pricing policies, and ongoing volatility amongst mid-cap stocks ahead of the OpenAI Developer Day today. We have just had an announcement from OpenAI that they are set to invest significantly in AMD, which has seen the AMD stocks shares rise by about 35% in the pre-market. Obviously, we had Nvidia investing in OpenAI just a few weeks ago, which led to another surge there, and we are seeing that this vendor financing dynamic continues to play out. That is certainly something to keep an eye on. In terms of the market dynamics, despite recent volatility in terms of price action, Goldman notes that their most shorted stocks outperformed hedge fund long counterparts by approximately 15% over the past month. So the most short interest pairings they have has seen its best month since the meme stock frenzy of 2021. And we will recall that post that 2021 period, we did see some froth coming out of the market. So that's another dynamic to keep an eye on. In terms of investor sentiment, prevailing belief that the current rally has momentum and could extend into Q4 as investors who missed earlier gains may start chasing returns into the back end of the year. Historical trends suggest that this squeeze can often continue in the near term without signaling any imminent significant decline, certainly in terms of the S&P 500. So like I say, we finished up just over 1% last week. Information technology made new highs for the week in terms of a sectoral perspective. September finished up 339 points of range, putting it in the middle of the monthly averages for 2025. For the month, the S&P 500 finished up 3.5%, up 13.72% on the year. And from those April lows, we're actually up now just over 38%. In terms of the calendar for the week ahead, obviously the government remains in shutdown, and we're getting press conferences this morning from the Speaker of the House to further updates with respect to that. So that's something to keep an eye on. I think as this shutdown extends, pressure is going to mount on Trump to make some sort of deal here and bring the government back. So we'll keep an eye on that dynamic. In terms of data, then obviously that's the shutdown impacting data. We'll potentially get jobless claims on Thursday. FOMC minutes will be released on Wednesday, and we have 10 and 30-year Treasury auctions. Keep an eye on demand there. And we will get remarks from Jerome Powell on Thursday. Also want to keep an eye on that for any updates on his perspective with respect to employment data. And then we round out the week with the University of Michigan consumer sentiment. So the data slate is pretty back-end loaded for this week. And obviously, there's always the chance that we do get the government reopening into the back of the week as well. So those are the dynamics we want to keep an eye on. And then as we head into next week, we will be starting to get bank earnings coming through at the back end of next week, and then we move into tech earnings. In terms of the market breadth, stocks trading over their 20-day moving average, 59% up from 51% last week. Over the 50-day, 59% up from 55% the week before, and those over the 200-day are 65% versus 62% from the week before. So comparing the sectors against their averages there, market breadth reads is rotating really. You're seeing some sector rotation, and all reads are above the 50% level, which suggests neutral to bullish read in terms of the price action. With respect to realized volatility, Realized volatility remains flat from last week, very low trailing month and realized volatility, but caution is warranted when we have implied volatility at such low levels. This suggests a high degree of complacency in the market, so there's always a risk of a volatility spike, and we know that seasonal trends suggest that we can see that occur certainly as we head into October. So something to keep an eye on. But like I say, for now, breadth remains positive, rotational more than anything, and realized volatility remains low. And in terms of gamma, what do we have there? Well, gamma traders are rolling up and out of the key strike, which was the 5,800. The JP Morgan collar set for Q4 now has 7,000 as the short calls and 66.30 to 53.40 as the put spread. So we certainly would anticipate if we start to trade up into the back end of this year towards that 7,000 level, I would anticipate that that area will act as some form of resistance. But we've got some wood to chop first of all in terms of earnings and data. So let's move to the technical picture. And in terms of where we are as we start this week, we have the weekly volume weighted average price is bullish. 66.55 will be the invalidation point there. So we're trading 67.82 as we head into the New York Open. So there's support down there into that 66.55. And we have 67.49 as the daily volume weighted average price, which is that 5-period look back, which would suggest the first signs of cracking potentially in the near-term momentum. But like I say, we're trading currently 30 points, 35, 33 points above that level, so no immediate stress there. In terms of the technical picture with respect to Friday's close, we did actually get a pin bar reversal from new all-time highs, but we are, as I say, challenging the highs set on Friday, or looks poised to challenge those highs, which were just below the 6,800 level. But note, we did make new highs and got the rejection. So it'll be interesting to see how we open up here as we head into the New York Open. In terms of the pre-market positioning, we have a pretty neutral read in terms of the overnight sentiment. However, the inventory overnight is 100% long. That means we're trading. Most of the price action has taken place above Friday's close, so we are in a potential gap scenario as well. So that's also something to keep in mind. And we continue to contract within this ascending wedge pattern from those April lows, and we are still holding up against the weekly projected trend channel resistance here. We closed just on it on Friday, and obviously we're challenging now as we start the week. So that's another factor to consider in terms of the near-term technical setup for the markets. But what I would say is that whilst we hold support here at the 66.20s, we now have a 5=1 objective versus this swing structure here. Let me just draw this in for you in terms of an Elliott wave scenario. So if we use this as our 1, 2, and we have our 3, 4. So the 5=1 now sits up at the 68.80 level. Also noteworthy that the October end of month straddle. So that's the market maker pricing with respect to potential range for the month. 66.02 being the downside support. 68.91 is where we may see some resistance in terms of implied volatility, and that coincides roughly with that 5=1 objective. So whilst we're trading above the 67.50s, that will ultimately be the target zone on the upside for this this current swing setup that I'm tracking. If we move to the intraday charts and look at the setup as we head into the week. So weekly projected range resistance is 67.91. Now we've tested that in the pre-market overnight, and we are finding some supply here, but note we are trading above the volume weighted average price and the midpoint and the value area low for the overnight session. So again, whilst we are seeing a little bit of profit taking there, nothing to suggest imminent downside action. In terms of the weekly bull bear zone, I'm using this week as the 67.20 to 67.10 area on the downside, and any pullbacks into that area, I think we should see some initial support develop from there. But in terms of the immediate setup, what I've been watching for now as we head into the cash session, if we hold the test that we currently have from the weekly projected range resistance, then we would set up a potential symmetry swing scenario. Let me just draw that in for you. So we could see price test down into the 67.50 level, which coincides with the weekly pivot and those prior cycle highs. So, like I say, if we do hold the current pre-market highs, then we could see some additional profit taking develop here, setting up a three-wave corrective scenario, taking out Friday's lows. But then, if buyers step back in there, we would look for a grind higher back through the prior cycle highs. Initial upside objective is going to be daily projected range resistance and the weekly R1 up into 68.20. Anticipate some profit taking there, pull back then to use these new all-time highs just below the 6,800 level as support, to then target the next leg to the upside, which is the 161 extension of this last significant corrective wave, which would coincide with the October monthly options expiration resistance area as well. Weekly projected range resistance. And so we would look for a test into the 68.40s. From there, again, I would look for potential profit taking to develop, and then pullbacks to use the prior highs as support before looking then for further consolidation, and then ultimately an upside move into that target zone above us at the 68.80s, 68.90s. The alternative scenario for me at this stage would be that we break out through the prior highs, and again, I would use this same structure. So I'd use the 68.20s as initial profit taking, look for pullbacks then to find support into these prior highs, and then the same setup to the upside would be the play there for me. Alternative scenario is that sellers step in here at the open and we get an inventory correction versus the 100% longs that we're seeing overnight. And we would look then for a move down to grind lower to test into our weekly bull bear zone. From there, I watch for bullish reversal patterns again to engage on the long side, and a similar scenario to play out with our same upside objectives. At this stage, we'll take a loss of the weekly bull bear zone to suggest a more significant bearish development underway, which would see us test back into our lows at the 68.80s. Then, as the weekly bull bear zone acts as resistance, we target weekly projected range support down to 66.40s and those prior swing lows at the 66.20s. As always, traders, plan the trade, trade the plan, and most importantly, manage your risk. Until next time, thanks very much.